So good morning, everybody that's here, and online. Hi to everybody as well. So as Rosemary said, today is the latest in our series of masterclasses or events around investment and preparation for investment. So we've done things in the past about term sheets, we've done things about data rooms. So today is all about pitching for investment. And what I'm going to do first, I suppose, Andrew is going to talk about the pitch and the do's and don'ts maybe. And we'll hear from John then on a practical level. So my role today is kind of to, even before you get to pitching, while you're looking to get investment, what kind of mindset and what kind of preparation you need to be doing in order to make a great pitch ultimately. Because the pitch, it's the culmination of a lot of work, sweat, effort, information, data that you collect as you go along, but it's also the starting point of a different journey in terms of your fundraising journey as well. So it's a very important junction that you will come across as a startup. So the premise for us in Propelor is that great startups don't fund themselves. So the type of clients that we deal with and are funded to deal with by Enterprise Ireland are startups that have scaling ambition built into their business plan from the get-go. So these are startups like yourselves that are looking to grow outside Ireland, to scale outside Ireland. They're solving a big problem. And in order to solve a big problem and to grow and scale, you will need outside investment at some stage. So that's the premise by which under which we're operating today, that great startups don't fund themselves. I came across that quote years ago. I normally would have a source for that. I can't remember who said it, but it is a great quote. And again, it's all about that mindset that you need to get into in order to go out there with positivity and clarity around fundraising. So where Propelor lives in all of this, so startups in Ireland there's a great suite of funding options available to them, and you can see them. We'll go to them a little bit in a second, but we live in that pre-seed, seed space with startups. So that first round where you're probably for the first time beginning to get into that investor mindset phase of your startup. So that in a practical level, that's with the Enterprise Ireland's pre-seed start fund, that 100k convertible loan note piece, and then the high potential startup investment, which is EI investing a little bit more money in conjunction with private investors. And that's where we do the private investor readiness piece as well around pitch prep. And that's why we're doing these series of events every year, because it ties in with our daily work. So what's very important is to get the right funding at the right time, the right phase of your startup's development. And that's part of our role. I wouldn't worry too much about the numbers per se, but just for illustrative purposes, let's say pre-seed is normally that 100k and less than that. Then you're into seed, which can be anywhere up to $1 million, $1.5 million kind of thing. And then Series A, $1 million plus, whatever. So you have to, as an entrepreneur, equip yourself with knowledge around the investment landscape. Who's investing what, and where can you get these particular types of funding? So, for example, the 3 F's are founders, friends, family. You can add fourth, fools as well if you want. They are very much at that early stage, but beyond that, you can't tap into that source, for example. Whereas with the likes of government agencies, EI could be with you along pretty much a lot of that journey, because even people think that Enterprise Ireland funding stops at high potential startup phase. It doesn't. That's the kind of the opening gambit. They can put lots more money into you once you get HPSU status. So they can be with you all the way. EU grants, as you grow and develop and have a bit more heft behind you, they might become an option. Accelerators, again, very early days. You have the likes of NDRC put 100k into startups as part of their accelerator. But beyond that, there isn't really scope for them to invest. Angels, the same. You have to be, understand where they live within this. So they might be able to fund some of your seed round, but once you get bigger into Series A, they probably don't have the pockets deep enough to help you. Venture capital then is where it's a bigger round and more onerous, I suppose. And you have to be at a certain level in terms of annual recurring revenue or monthly recurring revenue for them to be part of your journey. Some of you might be able to fund growth via customers if you're from the get-go driving sales. They can they can fund part of it as well. And crowdfunding is becoming increasingly popular and prevalent in the marketplace as well, in terms of their ability to fund significant amounts of investment. And again, worth looking at. So this slide is telling you that you have to understand where you are along your journey and what are the potential avenues that you can go down in terms of looking for funding.
I mean, I'll ask a question. Can I ask a question? Or?
You can, I suppose, yeah. Or
The EU funding is very interesting.
Yeah.
We weren't aware of that at all. So,
yeah, it's like the European innovation funds and that kind of stuff.
Yeah.
Now it's onerous enough in terms of the application. You have to be at a certain level in order to be able to do it, because there's matched funding elements and all that kind of stuff with it. But it is worth exploring, definitely. Yeah, a lot of companies ignore that avenue or don't explore it, but definitely worth exploring.
I was at a talk recently, and a VC was explaining that because of Trump and everything going on in the US, there's a lot more focus within the EU in terms of supporting startups.
Absolutely.
And I think even more funding now. So they're very open to doing it. So the timing seems to be right for that, you know.
Absolutely. And we're always telling our clients, in the recent past, it's become more prevalent to look to Europe for funding. That there is opportunities there, like you have the European Business Angels Network, so they're worth tapping into. So what we're saying here is the onus is on you. You can get advice from the likes of Propelor and all the rest of it. The onus is on you to map out what is out there. You have to understand who's actively investing at the moment, what kind of levels of funding, are there particular sectors. Like the list of VCs there, it's not exhaustive. There are just a few I kind of jotted down. But you have to understand what are Delta currently investing in? What size of rounds are they investing in? Where are they in terms of their investment phase? Are they finishing off? Have they used up all their funds and are now fundraising for the next one? So you have to become very aware of the scene, who's active, who's not active. There's no point in talking to somebody that will not invest in your type of startup, for example. Or there's no point in talking to somebody whose minimum investment is £1 million when you're not ready for £1 million to be injected into your business. So it's all about educating yourself, and we can help you with that part as well. But you have to be, I suppose, one of the takeaways is you have to be very clinical, and you have to be very organized in terms of what you're trying to do around building that database. Like any database that you build, like of potential customers or potential contacts, likewise with potential investors, you have to understand, as I said, who's active and jot them down and then go through them one by one. The angel side is a little bit more organized in that if you deal with the Halo Business Angel Network, for example, so they will get you in front of their investors. And beyond that, then there's outside of HBAN, you have syndicates like the Boole and Cork, you have Everest and Limerick, you have Awaken Angels investing in female-led startups as well. And then you have loads of informal groups and individuals who are investing very quietly every day in startups. Getting to know them is a little bit trickier, and that's all about network building and getting introductions and warm introductions into these type of people. The state is well documented in terms of what they're doing, but Enterprise Ireland, for example, in terms of numbers, are the most active VC in Europe currently. So last year they invested in 160 almost companies, 28 million. So in terms of numbers, EI are really, really active in that pre-seed and seed space. So well worth looking at as well. And John will attest to that afterwards. And then, as I said, crowdfunding, look at Spark, Kickstarter, Seeders and Crowdcube, all the rest of it. So in terms of pre-seed funding, to quickly move through these, but this is where the mindset has to shift slightly. So if you're going for PSSF, for example, have 100k convertible loan note, it's the first time when so if you've gone through that LEO process, for example, it's more about, tell us about the idea and how many jobs you can create. This will be the first time you'll be asked investor type questions. So, and this is the first time you're kind of, it's becoming that little bit more information is required, more traction is required, more proof of engagement with customers and the market is required. And this is your first dip of your toes into the investment space, as we call it. And then if you go beyond that PSSF, the next would be maybe high potential startup and private investment. This is where you're really then up to your knees in the investor world. This is where it probably gets very real in terms of having information to hand. And we'll talk later that one of the big blockages in terms of deals is not on the investor side, it's always on the startup side, not having the proper information available quickly enough for the investors to move on. So this is where it gets real in terms of, because you're dealing with EI, who are an investor, and you're dealing with private investors. The EI can't invest HPSU unless there's a private investor involved as well. So this is where, as I said, the pitch deck has to be right. The investor summary, the financial model, everything has to coalesce into a coherent story for EI and for the investors. And that's why we're doing this today and continues to do it on a daily basis, is to get that across to people. Because, for example, the HPSU, it looks like a form that you fill out, but it's not. It's interrogating you across a whole spectrum of what you're doing as a business and what your plans are as well. And part of understanding investors is understanding the process that they're going through. So you can see there kind of left to right. And again, this is not prescriptive by any means, but this is roughly what they're trying to do. So on the left-hand side, investors are constantly trying to build their pipeline. So they're out and about constantly looking for investment opportunities. So some join something like the Halo Business Angel Network because they can get a pipeline in. Some talk to the likes of us, the BICs, about what's on the horizon, what's coming, any good ideas coming that they might be investing in. Some are very quiet and they're so well known that they don't have to publicize the fact that they're investors. So they're constantly looking for investment. And then they have their own means of screening opportunities. So, and that is a science that's best left to them. They all have their different ways. Some like to invest locally, for example. Some are very sector specific. Some are investing within a threshold of money. They have a minimum and a maximum. They might look at what equity is available and, that they won't get out of bed for less than 15% or something like that kind of thing. So they have their own ways of screening. Some might give feedback, definitely not coaching. Maybe we're more on the coaching side, but some may give feedback. Others may just say, no, I'm not interested and thanks very much and best of luck and all the rest of it. But if you get back to that, and today then is about that pitching piece, if you get in front of them. Now, pitching could mean a formal pitch like they do in HBAN. It could be a cup of coffee. It could be an informal meeting. So that means you always have to be on. So you might not have the crutch of a PowerPoint slide deck with you, but you still have to hit all the relevant points when you're talking to them about the size of the opportunity and the journey that you're on and everything else. So pitching there is a broad one. And then then there's that DD, that due diligence piece. So that's where they do a little bit of a deep dive into you, maybe as an individual, your financial model, your business plan, your route to market, your customer list. And then make a decision about to negotiate with terms, what equity, by what mechanism. Is it a convertible loan note? Is it equity? Is it a safe? And hopefully everything goes well and the investment is made. And then the next phase of the journey starts post-investment in terms of building that relationship with this individual or this fund or this organization and how that pans out. So just to give an indication, I have two slides here. One is from the founder side and the other is from the VC side. So this is a company that we won't mention, raised 1.6 million a number of years ago. And I think before he frightened people, he said, founders, stay positive and stay persistent, right? And that's one of the things we say as well. And it'll come up that you have to be persistent, resilient. You have to be positive as well. So in their 1.6 million raised, they had 287 contacts. So they did what I said earlier. They compiled a list of seed funds, individuals, all of these groups, and put them down and contacted them. So 100 took the pitch or the meeting or the coffee or whatever you want to call it. We don't know exactly what way it went. 50 said no after the pitch, but come back later. Now that's kind of annoying in that come back later, when or what. That's there. Sometimes we see that VCs or investors have FOMO, fear of missing out. They want to string you along a little bit in case some other investor is looking at you as well. So what you want is the next one. You want a blanket no sometimes. If you're going to get a no, you want, do you know something? It's a no, and you can move on, and that's better. So of the remaining 18, 3 invested. So that's 1% success rate. Not to frighten you too much, but also to bring a dose of realism to this, that it is extremely competitive. So John had lots of publicity this week, and congratulations, John, a Go Challenge on raising their pre-seed seed round. But for every successful press release, there's an awful lot of startups who are crying because they can't get investments. It's really, really competitive. But if you do things right, you improve your chances of getting it. From the VC side then, they were talking about, and then this is just kind of rough stuff, when they screen initial deals, 85% progress to the next stage, which we thought is extremely high and very generous, but maybe again there's that FOMO piece. That initial pitch, 30% go on, and you filter right down. So they have investment 3.5% of the total deal flow. So again, you can see how competitive it is, and you have to be realistic that when you're starting your investment round, there's lots of other startups at the very, very same time doing the very, very same thing and going to events like these. So it's highly competitive. And that's why I think if you're focused and very diligent in who you actually target, sometimes you reap higher rewards rather than a broad spread of potential investors. So it's not all bad. Like we would say, private investors, they do provide that early stage capital, so vital for startups. And that's why that PSSF, that 100K with Enterprise Ireland, they increased it from 50K from the old competitive start fund. It's more meaningful. You can do a lot more with 100K. So early stage investment is so important to get you off the blocks and up and running. Angels and private investors, they're a little bit more flexible. They can make decisions relatively quickly. There isn't maybe the structured approach that some seed funds and VCs might do as well. So we would be very positive towards using private investors for early stage investment. And they also bring a lot more maybe than and I'll talk about that in a minute, than just the pure funding. But like anything else, there is cons as well. So they might not have the ability to follow on with investment. It can take a lot of time and effort to find somebody suitable. You are technically giving up a share of your business and maybe some of that decision-making ability that you might want. And you might have somebody that's maybe not interested in helping on a day-to-day basis, or you might have the opposite, somebody who is overpowering and wants complete involvement in your business. And that's a recipe for disaster as well, if the two of you can't kind of meet in the middle. So up to now, I think maybe the tone has been a little bit around that you're kind of beholden to the investor side, but you have to be aware that it is a two-way street, that you are also looking for the right investor and interviewing the investors as well. Are they going to come on board in a way that suits you? Is it smart money, for example? Can they shorten your journey if they've been there, done that before? Do they have a network that you can tap into? Can they give you lots of advice and connections that will help you along? Have they done it before, which is really, really important. What you don't want is a naive novice investor who probably needs education around being an angel investor, and you don't want to be the guinea pig doing that. There has to be an alignment with motivation. So you're outlining your vision. So the investor has to be very on board with what you're trying to do as well. And then we're now getting into the real mindset piece. This is a culmination of years of kind of research that we've done, and it can change. But and you could talk to 10 different investors, and they might all have something different. But this is kind of where it's kind of at. I think number one is the team. Can this team execute the plan that's presented to the investor? And is there that level of trust for the team that they can actually deliver? The revenue potential, how big can this get internationally? How scalable is it? And then what's the exit? How can they get not their money back, but multiples of their money back? And how can they do that? So here we're just, again, as you're embarking on your investor readiness journey, and this is from Barry Brennan in Elkstone, and these are some of the challenges they have seen over the years when talking to startups, and maybe how you can, if you feel you're in any one of these positions, how you can overcome it. So you're looking at the data and the market is looking kind of small. They can say, oh God, what do we do about that? So find a bigger market, or find potential other markets that your solution can be useful in. Explain maybe that this is just step one of your journey, and that down the road there's other applications and other products that are coming that will enhance the offering as you grow. Or something like Airbnb, to demonstrate that this is a new market and that existing data is not available to show how attractive this is. But again, that's all about that trust piece, that they believe you, that what you're saying is true and you have the data to back it up in some shape or form. B2C businesses, tricky for investors that kind of do, they get worried about this in terms of the cost of it, how to get customers. Now there are some investors that like B2C businesses. So again, you have to target those people and get talking to them. A lot of advisors would say, can you turn it into a B to B to C business where you're selling to businesses and then they sell on to consumers? That is often on accelerators or new frontiers. There I say that you do get that message. Can you not turn it into a B to C? But it is more attractive to investors. And then crowdfunding platforms are a great way if you have a B2C model, because then you're not only getting customers maybe, and you're getting advocates for your offering as well. Number 3, the double-sided marketplace of supply, demand on either side of your model. Find there is investors that like these type of models. Again, you have to target them. You prove your business case is in a particular niche, then raise funding against the metrics. So it's all about, can you prove that this works in a small way, and say, if I get investment, I can extrapolate it out and grow the business. Or if you can get the supply side or the demand side and say, look, they're locked in, and now the investment is going to get the other side of the business as well, and prove that you can do that. Or just go purely business to business again. So the message here with the consumer side, it can be a little scary for investors. Hardware. Sometimes if it's just a hardware play, again, there are hardware investors. If you look at medical devices in Ireland, very active in the West. There are investors there that invest in medical devices. So it's not all bad news. Or if you can build in some sort of recurring revenue into the model, like Nespresso did with their capsules, or build in something around SaaS, an offering around data or something that you can have recurring revenue. You can partner with a hardware supplier, so they look after developing the hardware, and you're concentrating then on sales and driving the growth. And again, crowdfunding is very important here. The wrong team with the right idea. And now, I'm not saying the wrong team per se. Sometimes it's a solo founder can find it really hard to get investment, because what you're saying is, with investment, you're talking about execution of an idea, and can one person execute that idea? So sometimes we tell people, you need a co-founder, you need somebody to share the load and drive the business on. If you're technical, 100% technical, you need a hustler, you need a salesperson, you need somebody out there who's going to drive the sales. Same with spin-outs from academic institutions. Big questions there. If you're an academic founder, are you willing to give up the academic career to go out and run this startup as a CEO or whatever? That's a very big question. And also then the lack of commercial experience. And that's why we see with some spin-outs that if you can partner up with a commercial lead or somebody who has strong experience in sales, then that's a real bonus. Because every startup, no matter what they do, becomes a sales organization. Ultimately it is about sales, and that's where everything ends up being. You have a terrible idea, or an idea that's less loved, let's say, right? But this is where you need, before you ever go looking for investment, you have to make sure that everything stacks up. So you might have an initial idea, and then it kind of coalesces into something else based on the data and the information. And we had Scurry down in Wexford, and knows everybody aware of that company. They came in with an idea originally about backfilling trucks, loads that were coming back and forth to Ireland, and that's now morphed into something creating labels for big companies in delivery labels for companies in the UK. But they took an initial idea and pivoted. So nothing wrong with having the bones of an idea, but if the data isn't stacking up for you, then you need to pivot. It's vital that you get proper advice, mentorship, consultancy, and Ireland is awash, probably too awash with the potential supports that are available, because part of what you're trying to do is decipher who does what and when and all the rest of it. And then surround yourself with good friends that will be honest with you, not that are constantly patting you on the back. What you need is a friend who will say, that's a crap idea, or you're going in the wrong direction here. So it's always good to get positive stuff, but as we say, we give to our clients, we give that tough love bit. You know, we're being honest, but it's coming from a good place, even if we're telling you have a terrible idea. If you haven't, so the further you go along the journey, zero traction or customer validation, this gets really, really important, even at PSSF level, that first engagement. So you have to demonstrate some traction, some engagement with the marketplace, with customers. Build an MVP, minimal viable product. Give it away for free if you have to. Get it used, get it broken, get it out there and get it used by the potential customers. And finally on this, cap tables. The temptation for a lot of startups, as you're going along your journey, you're giving away bits of equity for stuff that people do because you don't have anything else to give them. And it can end up very, very messy. And this is where it kind of gets technical. Piece of advice here, get a good solicitor. Make sure everything is tied down. Even with co-founders that are mates, everything has to be locked down legally. You might not be mates forever, and suddenly you're losing a chunk of your company. So the advice here is get a good solicitor, not your family solicitor, unless they happen to be an amazingly commercially able solicitor as well. Get somebody who understands this process. So my final slide is around that particular mindset. So you're just about, Andrew's coming up next talking about the pitch. So you're just about getting into that phase of your journey where you're pitching. What do you need to be doing in terms of your mindset? So the first thing is you need confidence with clarity. So you need to show your passion. Investors invest in people as much as ideas. So you have to come across as very, very passionate about what you're trying to achieve, but you're underpinning that with data, with facts, with research, with a good business plan, with a good financial model underpinning it all. You need to be resilient and adaptable. So raising funding is a marathon. It's not a sprint. You're going to get an awful lot of no's along the way, but the good entrepreneurs, the good startups learn from the no's and adapt. So if you're constantly hearing the same question being asked, you must ask yourself, how do I stop that question being asked in my next presentation? So be adaptable. You need to understand the investor mindset. Get inside what makes them tick. And I'm not telling you here to say what they want to hear, because that's the wrong thing to tell you to say, but highlight particular areas in your presentation that they need to hear. How big is this opportunity? How big is the problem? What's the route to market? You know, what's the scale potential of this business? You need a relationship-oriented support. Ireland is small. Do not burn bridges. So do not badmouth an investor who said no to you, because you could walk into a room the following week and that person is there and he's heard what you've been. So if somebody has said no but come back to me, it's good practice then to, with their permission, email them every couple of months with progress that you have made, and keep that relationship going. You need strategic persistence. So you need to, as I said, keep the relationships going, don't burn bridges, and keep that relationship going with as many people as possible. Be prepared for DD, for due diligence. As I said, deals fall down, the majority of cases, on the startup side. have your financial model ready to go, your business plan, your pitch deck. If you have IP, have your patent certs, all of that sorted. Have your cap table, everything ready to rock and roll. That if you have a successful meeting or a pitch and somebody says, can I see your financials? And you say, yeah, I'll have them ready for you in 3 weeks. Like, you're dead in the water. And that happens a lot. That happens a lot. And long-term thinking. So it's when you get that first round, sorry, John, when you get that first round, it's not the time to sit back and say, way, well done us, brilliant, we've done it. It's probably just the first round. So you have to long-term thinking, where is this round going to get me? What am I going to achieve with this round? And when am I likely to be going back out there looking for investment? So I'll leave it to Steve Jobs. He says, I'm convinced that about half of what separates the successful entrepreneurs from the non-successful ones is pure perseverance. And that's what it's about. So it's about keep going, be positive, and be resilient. So thank you very much.